Welcome back to another explainer. Today, we're throwing TriNet Group right into the ultimate valuation gauntlet. As an investment analyst, I'm going to run this stock through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, just to see if it actually deserves a spot in your portfolio. We're talking hard numbers, competitive moats, and strict intrinsic value calculations. So let's get right into it. Here's our roadmap for today. First, a quick TriNet company snapshot. Second, we'll look through the Warren Buffett lens. Third, the Peter Lynch lens. Fourth, the Benjamin Graham lens. Fifth, we'll run a modern DCF and alternate valuations. And finally, number 6, we'll synthesize it all for our final verdict.
Section 1. TriNet Company Snapshot. Let's set the stage and see exactly where this business stands right now in a pretty complex economic environment.
So TriNet is currently trading at $45.82 a share, which puts its market cap right around $2.1 billion. Now, if you track the human capital management space, you know TriNet operates as both a professional employer organization, a PEO, and an administrative services organization. Basically, they're the ones bundling payroll, benefits, and HR compliance for small and medium-sized businesses. But check out this really fascinating dynamic from their first quarter of 2026. Their core worksite employee volume actually dropped 12%, mostly from client churn in the tech and professional services sectors. But, and here's the kicker, their strict discipline in repricing health benefits pushed both net income and free cash flow up. So even though revenue shrank 5% down to $1.226 billion, net income climbed 5% to $89 million. They're literally trading volume for margin. Moving on to Section 2, the Warren Buffett lens. Let's see how TriNet holds up under the scrutiny of the Oracle of Omaha. You know, Buffett, he absolutely demands a strong economic moat. And TriNet definitely has high switching costs working in its favor. I mean, once a small business locks its entire payroll and health benefits into a single platform, they are incredibly reluctant to rip that out and start over. Plus, TriNet has deep vertical expertise. But that moat is definitely under siege. They're facing fierce competition from nimble HR tech platforms, not to mention the looming threat of AI just totally disrupting traditional HR models. So there is a moat for sure, but it's not exactly impenetrable. We have to weigh that sticky ecosystem against the real risk of tech disruption. When we look at the financials, TriNet actually passes quite a few of Buffett's qualitative metrics. Management discipline? Check. They're strictly controlling expenses, bringing their insurance cost ratio all the way down to 84%. Earnings consistency? Also a check. And debt? Well, they do carry $896 million in long-term debt, but they're sitting on $340 million in cash. With their massive operating cash flows, servicing that debt is a total breeze. Now, the holy grail metric for Buffett is owner earnings, basically the cash left over after maintaining the core business. And guys, TriNet generated a staggering $123 million in free cash flow in the first quarter alone. This proves they generate plenty of cash to fund growth, acquire strategic targets, like their recent buyout of the leave management app Cocoon, and aggressively buy back shares. In fact, they repurchased $58 million of stock just in Q1. For a Buffett framework, that kind of cash generation is a massive, massive positive. All right, Section 3, the Peter Lynch lens. Time to figure out exactly what kind of story this stock is trying to tell us. Lynch famously categorized companies, so he knew exactly what he was buying. Now, given that 5% drop in top-line revenue alongside a 5% jump in net profit, Lynch wouldn't call this a fast grower. He'd likely label TriNet as a stalwart. It's a reliable profit engine. You buy a stalwart for steady, predictable gains and a good night's sleep, not necessarily for explosive overnight expansion. Crunching the numbers, Lynch would absolutely love this valuation. If we annualize their Q1 EPS of $1.90, we're looking at a forward PE ratio of roughly 6.5 times. That is incredibly low. And since their bottom line growth outpaces that PE, the PEG ratio looks highly attractive. Combine that low multiple with an adequate balance sheet and management gobbling up 1.3 million shares in a single quarter, this becomes a seriously intriguing holding. Through the Lynch lens, TriNet is a solid hold, at least until they can reignite that top-line revenue growth to complement those share buybacks. Section 4. The Benjamin Graham lens. Time to run TriNet through the most ruthlessly conservative test of them all. Graham is all about extreme safety, right? And TriNet actually breezes right through his basic defensive checklist. Adequate size? Pass. It's got a $2.1 billion market cap. Strong financial condition? Pass. With $258 million in working capital. Earning stability? Pass. With 10 solid years of profitability.
Dividend record? Pass again. They reliably pay a dividend that was recently bumped up to 29 cents a share per quarter. But here comes the ultimate Graham test, calculating strict intrinsic value. His classic formula takes the square root of 22.5 multiplied by the trailing earnings per share multiplied by the book value per share. And this is exactly where asset-light tech and service companies usually hit a brick wall. Because TriNet operates with a super low book value per share of roughly $1.80 and an annualized EPS of about $7.60, the formula spits out an intrinsic value of just $17.54. Wow. Graham loved hard, tangible assets. Think factories and real estate. So an asset-light service company like TriNet drastically fails his margin of safety test at current prices. For a strict Graham disciple, this is a clear sell, simply because the hard, tangible assets aren't there to protect your downside. All right, let's move to Section 5, DCF and alternate valuations. Let's step out of the past and build a modern quantitative model. By forecasting future free cash flows, we can find a modern intrinsic value. Let's assume a fairly conservative weighted average cost of capital of 9% and a modest 2% perpetual terminal growth rate, just to account for that declining top-line revenue being offset by expanding margins. Running that base case discounted cash flow model, we get a fair value of $54 per share. And this brilliantly highlights the upside potential here. Across the board on modern quantitative models, TriNet is trading at a notable discount. At $45.82, it sits comfortably below our DCF fair value of $54, well below the average Wall Street analyst target of $61.50, and it trades at a massive discount compared to industry EV to EBITDA multiples. So quantitatively, the stock looks to be undervalued by roughly 15 to 30% right now. Finally, Section 6. Synthesis and final verdict. We've run the gauntlet. Now, let's pull all these disparate models together into one cohesive verdict. Looking at our summary table, TriNet presents this really fascinating split, doesn't it? It's way too asset-light for Benjamin Graham, earning a hard fail. Peter Lynch, on the other hand, would happily hold it as a reliable stalwart. But its massive, cash-gushing nature completely wins over the Warren Buffett framework. Plus, modern DCF models flag it as a clear buy with a very solid margin of safety at these prices. So what's the bullish thesis? Well, TriNet has proven an incredible ability to trade volume for margin. By repricing health benefits, they squeezed their insurance cost ratio down to 84%. They are also rapidly modernizing. They've rolled out this AI-powered TriNet Assistant to automate HR inquiries, and they acquired the leave management app Cocoon to embed themselves even deeper into their clients' daily workflows. That creates incredibly sticky retention. Conversely, we have to stay totally objective about the risks here. You simply cannot permanently shrink your core user base by 12% a year without eventually hitting a brick wall. Small and medium businesses are incredibly fee-sensitive right now. And frankly, while TriNet is leaning into AI, there's a very real long-term risk that broader AI automation could empower these small businesses to handle HR natively, completely bypassing outsourced PEO solutions altogether. Blending all of our lenses together, TriNet earns a cautious buy rating at current levels. That $45 entry point gives you a highly profitable, cash-generating machine at a very fair price. You're getting a 6.5 forward PE and a management team that is aggressively returning capital via buybacks and dividends. If you actually believe their technology roadmap will stabilize that shrinking employee volume over the next year, this stock absolutely deserves a spot on your watch list. But we're going to leave you with this final thought to ponder as the entire HR industry transforms right before our eyes. Will TriNet's aggressive push into AI and automation ultimately save its margins, or will those exact same AI tools empower small businesses to just handle HR entirely on their own? Think about it. Are they building the HR platform of the future, or just extracting maximum profit from a legacy model that's slowly being automated away? Thanks so much for joining us for this explainer, and we will catch you in the next one.